Yo, what's up, everybody? John the Economist here, and we are live. Per usual, to start off the stream, I am going to make sure that I am streaming in all locations properly because, I prefer not to waste any time streaming to things that aren't actually streaming. That would not be cool. Looks like Facebook is good. Looks like Twitter is good. Looks like YouTube is good. Sweet. Awesome. So real quickly, I'd like to get something out of the way, which is I came down with COVID this past week. So I've been basically inside of this box for the past 4.5 days now, as I have roommates and I'm not trying to get them sick. So access to the kitchen and the bathroom has been very limited. It's mostly just been this box. Thankfully, I have my cat over here that's been hanging out, and thankfully, I have all my friends inside of this computer screen that I get to hang out with, like right now. So I think I put together a really awesome lesson plan for you guys today, but this is a very selfish stream as well because it is a nice, hour and a half of entertainment as I sit staring at the same walls and same computer screen every day. Anyways, now that we got that out of the way, I'm super excited to get started. So, main thing that we're going to be covering is inflation because even though it's a repeating topic, it is an increasingly more newsworthy and drastic event because of the fact that it's just shattering records and increasing at a rate that we have not seen for decades. There's only probably one other time in all of American history that really rivals this level of inflation. So, yeah, super fun stuff. On top of that, I think it's no secret that the stock market and the crypto market has been bearish recently. I posted a video probably about 2 months ago describing these bearish patterns that we are noticing. I did not reinvent the wheel. Things were already down 30% plus when I was like, yeah, we're in a bear market. That does not make me a rocket scientist by any means because it was more than blatantly obvious that we were in a downtrend at that point. But there's, good guidelines and good context to paint there. Um, let's see here. Sorry, I just need to, be selfish for just a moment and see when I posted that bear market video. Yeah, it was like the end of February. So it's been about 2 months now that we've been in this fun little downtrend situation. Very nice. So the first thing that we're going to take a look at are the inflation numbers. First, we're going to take at the consumer price index, and we are going to put this on a time frame that is actually helpful. Also, per usual, if you are watching the stream, I would absolutely love it if you added comments, keeps the discussion going, allows for topics for me to riff on and answer questions on. I am here for your entertainment and your educational benefit. So yeah, the less I have to talk to myself and the more I can talk to you, the better. So any and all questions are more than welcome. Anyways, so I think like looking at this, yes, we've been in a pretty steady uptrend for, well, ever actually. But if you zoom in here, we can see that there are phases that have totally different trajectories than others. The first is the 1980s that are worth looking at. And then the second would be right now, where you can see this very clear shift upwards, right? We had what I, call like a honeymoon phase from the pandemic and a couple months after the pandemic. We hadn't really caught up with all of the stimulus and quantitative easing that we were doing. That's just fancy talk for we were printing gobs and gobs of money and giving it out for free. And believe it or not, free money comes at a cost. So we just kind of trended in, the same kind of direction until about fall of 2020, I would say, is where we really started to hit liftoff and never looked back. A better way to look at this is by going into Fred's little edit thing here and then doing percent change. And then we're going to zoom out again, and you can see just how unprecedented this time is, right? We're looking at the past decade. We can zoom out even more, right? Again, the only other time that, it really took this trajectory was the 80s or so. So I'm going to, right? And even then, not quite as easy to identify just how bad that looks. I don't know why Fred's not cooperating with me right now. I'm going to refresh this. There we go. Oh, that's percent change from a year ago. I'm nailing this. I literally practiced like going through all these math functions so that I'd like limit the amount of time that I did that. And here I am still doing it. So as you can see, like the 80s were pretty bad, right? And we had, one really bad inflationary period during 2006. But if you were to normalize that, this probably would not show up there. And the best way that you can do that is by, instead of just doing standard percent change on a monthly basis, you can either go to an annual basis, and then that takes on the shape of this, right? Or you can do compared to year over year inflation changes on a monthly basis. And you can see that we are soaring probably towards these kind of levels again. So very awesome stuff. It is basically the highest year over year and month over month inflation on record in the past 50 years or so. Lots of fun. The other thing that I think is really interesting, so this is the consumer price index, right? This is you, the consumer, paying for this stuff. You're going out to the grocery store, right? You're getting your mixed bag of goods that they use to calculate this, and this is what you get. It's this much higher than it was previously, right? Again, we can like zoom in just to contextualize, like this is wild, right? What also is very interesting is the producer price index. And if we were to do the exact same thing, zoom in on the index. So far, as far as rate hikes, we have had, let me look at that. Beautiful. So far as rate hikes go, we have had a increase of 50 basis points. It sounds like there is upwards of a 95% chance that we will also do another 50 basis point increase next month, which means that interest rates will effectively go from 0 to 1% between March and May, right? They're at 0% in March. We went up 50 basis points here in April. We're going to be going up 50 basis points in May. Projections suggest that we could go as high as 3 to 4% this year, but the Federal Reserve almost always falls short of those projections. I have a graph illustrating projected interest rate hikes and actual interest rate hikes somewhere, but I don't think I actually have that floating around in this lesson, but worth noting. Hi, Brandon. How are you? So the other thing that's worth noting is the producer price index, which is just insane. And again, we are going to go to percent change from a year ago. And we're going to zoom out so that we get some more context. And we can see that, we're at all-time highs, baby. This is the highest percent change in the amount that it costs for producers to produce stuff based off of raw goods, right? Commodities, for us to consumer price index. So, a lot of people are blaming inflation on two things right now. And by a lot of people, I mean politicians that need to control a narrative as to not look bad. And those two things that they are blaming inflation on are one, corporate greed, and two, Putin, right? You're going to be hearing Putin's price hike a whole lot. What they fail to recognize is that this has been the trajectory since basically the pandemic started, both on the consumer price index and the producer price index. And last I checked, that war started 2 months ago. Don't get me wrong. This war is 100% a contributing factor to increased percent growth in inflation, right? Absolutely. I will not deny that for a second. Supply chains are getting clogged up. Commodities the supply of commodities is decreasing. The overall level of global trade is decreasing. There's a lot of macroeconomic uncertainty. So the war is 100% contributing to inflation. It is not at all the cause of inflation. The cause of inflation is the fact that we printed a ridiculous amount of money over the past 2 years. I will keep referencing this graph because the inflection point for which we started skyrocketing is obvious. It was when the pandemic started and we started printing a ton of money. The other thing that I want to address is corporate greed. Again, the corporations are dealing with this the same way that we are because all of their raw materials, if you're talking standard manufacturing, things like that, which is where people are pointing to when they're saying corporate profits are at an all-time high, when they mention grocery stores and Amazon and things like that. But you have to remember, like, they have inputs just like everybody else, and those cost money, and they actually are the rate at which they cost money is increasing even more for the producers than it is the consumers. Don't get me wrong, some people are probably taking advantage of this environment to raise prices even further, but corporations going to corporate and profit seek. That is literally what they do. Any publicly traded company has a fiduciary responsibility to maximize profits. That's kind of a part of the rule book. So if they can get more profits out of the situation, they're going to get more profits out of the situation. But gas prices in April of last year were $2, and now they're upwards of $4. The corporation didn't decide to be greedy now and be altruistic and generous a year ago. The market conditions changed, and their cost of producing things significantly increased and rose, and they have to pass those costs along to us in order to continue to enjoy the same profit margins that they're used to enjoying. That is how markets work, right? Can't blame corporations just arbitrarily deciding, waking up one day and being like, I'm going to charge higher prices than usual, and let's just hope people are going to roll with it, because that's not how those things work, right? There's a endless list of functions that play into this market that dictate prices. I'm going to go on a moderate rant here because I think it's really important, fundamental economic knowledge. And that is that the pricing mechanism is a language. We're going to go to my fancy drawing board here. Also, per usual, Polar Seltzer. I drink it every stream. Delicious. You should endorse me and give me money. Also, Skittles should endorse me, because I'm not joking. Since I got sick, I've probably eaten about 3,000 calories worth of Skittles in 5 days. I'm not proud of it, but that is how the math shakes out, as I'm about halfway through my second family-sized bag. Oops. So, the good old supply and demand graph, right? So for those who are not familiar, the x-axis is quantity. The y-axis is price. You have a downward sloping demand curve and an upward sloping supply curve. Hey, Steven, how are you? Thanks for tuning in. Got 6 whole people watching. Awesome. So why is this important, and why am I drawing attention to this when we're talking about inflation and corporate profits? It's because the pricing mechanism is a language for buyers and sellers to communicate value to one another, their own subjective value. What that means is that I probably value things differently than other people that are also looking to buy the same things, right? And people are trying to sell things at certain levels that other sellers are maybe willing to let it go for, right? There's a variation on both sides of that. The process of a market is matching these buyers and sellers through continuous, let's call it, dialogue through this pricing mechanism until you get at what's referred to as an equilibrium price. And these two ends are technically competing with one another, and yet they end up benefiting both sides of the equation. What I mean by this, the demand curve is downward sloping. The reason why is because the more you have of something, the less utility you derive from it. Let's take price out of the equation for a moment. The best way to illustrate this example is, let's say you get to attend an all you can eat buffet with your favorite food, right? And we'll just use pizza as the example. Even though the food is free and it's an all you can eat buffet, you're eventually going to stop eating. Why? It's because you get diminishing marginal utility with each additional pizza that you eat. Eventually, at a certain quantity, you are not going to receive any benefit from eating any more pizza. In fact, you're probably going to get, a bellyache, or you're going to get sick, and then it's not going to be fun anymore. Suppliers at increasing quantities would be happy to sell things at a higher price at increasing quantities. Hence, the upward sloping supply curve, right? This is the price that they are happy to sell this quantity at, right? Where these two lines meet up is where you get an equilibrium price at an equilibrium quantity. They are competing ends with one another, but what they do is normalize the pricing of a good, right? Let's assume this good that we're looking at is toilet paper. Why toilet paper, John? Because during the pandemic, supply remained the same, but everybody got real freaked out about their toilet paper situation, and demand increased substantially. And what the pricing mechanism said was, hey, producers, make more toilet paper. And also, on top of it, we're willing to pay a higher price because we're scared that we're not going to have any toilet paper during the entire pandemic, or whatever reason that happened for, right? Very simple example, but it's a great way to illustrate how this pricing mechanism changed the price of a good based off of this language that both the buyers and sellers were speaking to one another without even knowing that they were doing it. So again, when we talk about corporate profits, right? Like, I'm sure gas companies are enjoying some very super normal profits right now. All that happened was the demand remained constant and supply decreased. You get a lower quantity, meaning you get a higher price. It's not because they're evil. It's because for the market to continue to function the way that it previously was, you're going to have to charge higher prices. So again, long-winded answer, but Vladimir Putin, as much as he's a super evil, not cool guy, is not responsible for American inflation that has been persisting for about the past 2 years now, nor is corporate greed, right? These two things are just additional inputs into this broader system that is dictated by, generally speaking, buyers and sellers, and generally speaking, what we're doing with our money supply, which has been unprecedented, hence the unprecedented inflation. So hopefully that was a decent explanation. Again, if some of that stuff didn't compute, if you'd like me to rephrase some stuff, repeat some stuff, feel free. But one thing that I think is really cool about the market mechanism is that in order for all of these goods to get to where they need to be for people to buy them at the right time, at the right quantity, all the time, you need what Leonard Read referred to in his book I, Pencil, a number of innumerable antecedents that have to come before it. And what he means is that nobody can produce a pencil by themselves, right? Because Brandon, tell me what part of it is making your brain throb, and I will be happy to explain, because that's my fault, right? If I can't put the stuff in plain English, then I'm screwing up here. I think that's why Milton Friedman, while not the most correct economist of all time, is one of the greatest economists of all time, because he could always describe these concepts in plain English. And speaking of, he actually had a great speech on iPencil back when that essay was popular, right? And the idea is that nobody can make a pencil by themselves. It's not possible. You need, an entire business dedicated to harvesting rubber for the erasers. And you need an entire business for milling the lumber, an entire business dedicated to painting, an entire business dedicated to mining graphite. And none of these functions, as they're doing it, are like, oh, it's for this pencil that somebody will use and enjoy. They're just responding to this infinite web of price signals that they are just getting up and acting upon. They know that somebody somewhere, for some reason, wants the graphite that's used for the pencil lead. And, the lumberjack somewhere for some reason knew that somebody was trying to buy the wood. Didn't matter to them. They were just following those price signals, right? That's the beautiful part about this market process, that a somebody trying to centrally plan such things could not do themselves, because they could not conceptualize all the things that need to happen in order to create any specific good, right? All of these is just a web of market functions, price signals, languages that are being spoken through the pricing system in order for goods to end up at your grocery store, at your gas pump, wherever things are convenient to you, right? It's not because like they're doing it just because, it's because there's just an infinite web of pricing signals communicating those things to everybody. So anyways, to conclude, record high year-over-year percent increase in consumer price index, record high year-over-year increase in producer price index. We get a nice inflation sandwich. Other thing that I want to talk about, because, a narrative that I've been hearing over and over and over again, especially since the pandemic started, is we're in a bubble, we're in a bubble, we're in a bubble. This bubble is going to be worse than the dot-com crash. And I did some due diligence on that last stream, and I'll probably do some more on it this stream. But it's hard for me to claim that we're in a bubble when everything's in a bubble, right? Because where does that bubble deflate to in the market if asset prices everywhere all the time, including our own money that we use to buy stuff, is inflating, right? And one of the things that I want to take a look at is the housing market. And same thing here. I'm going to do some fancy, we're going to do percent change from a year ago. We're going to normalize it. And we're going to get this nice graph of the past 2 decades. And what do you see, right? To me, I see the craziest, average increase of housing prices that we've seen in 3 decades. Not even the housing bubble had, gone to such insane levels, right? We can back it up even more. Right? Like, in context, this looks nuts, right? It looks like an absolutely unprecedented time in the housing market. And in some ways it is. But the problem is that the things that cause the housing bubble to burst, and the things that caused the housing, bubble, this increase in housing prices right now, are entirely different things. And for that reason, we cannot treat them the same. And unfortunately, the bad news is that I'm not totally positive as to when housing prices will eventually decrease, because I don't think it's going to be in some catastrophic bubble pop. The main thing that points to this, and my buddy Kanan, who I think owns quite a few homes that he rents out, so it's a pretty prominent side business of his, is the one that brought this to my attention. So shout out to him. But this was the risk of default, right? So this is your mortgage credit index, which means it's like the likelihood that you're going to be able to get a mortgage. It's the difficulty of getting a mortgage. And as you can see, during the housing bubble, it was the easiest that it had ever been to get a mortgage. The lending risk was insane, both on the lending side and the borrowing side. People were going crazy on super risky things just to make a sale happen, right? And that's, you're selling to people that cannot reasonably buy. That's textbook how you get a bubble, right? And then that bubble deflated, and ever since then, it's actually been getting increasingly harder to get a mortgage. So the function that caused the housing bubble in 2008 is quite literally not present whatsoever this time around. So we can have a lot more faith in that increase in the housing prices. It's not like a false bubble, right? People aren't taking out mortgages that they can't afford. They're actually offering to pay in cash at above market rates, at above asking price, just so that they can lock in a deal, right? That means that the buyers have all the cash necessary to make that happen. It sucks. Don't get me wrong. It's not good. I have my buddy over I think the past 2 years has been trying to get a house and has been offering above the asking price time and time again, and has still not been getting his offers accepted. but we can't call this a bubble and just hope it's going to pop and deflate and houses are going to be super cheap again all of a sudden, because I don't think that's the case. Thankfully, I think there can be a cool off phase eventually. I think primarily related to inflation and commodities prices coming down, because you need a lot of commodities like, lumber and things like that in order to build a house. But I think overall, it's in a really, really tough spot. And if you're a young buyer in this market and you don't have a ton of capital to throw around, it probably feels really brutal out there. But that doesn't mean that we're about to have a bubble pop, right? And same goes for the stock market and asset prices everywhere else. I greatly underestimated how easy it would be to talk for this length of time while being sick, but I digress. Okay, I'm seeing a nice, thoughtful question from Gregory. So I'm going to take that real quick. Okay, there's a lot to unpack here. And look, Keynes had some good ideas, but Keynes also had some very incomplete answers for our current situation. And on top of it, Keynesian economics and modern monetary theory are different things. They're not the same. So worth noting. But Keynes' idea, right? We're going to go back to our very beautiful supply and demand graph, was that if you're in a recession and this market function is not filling in the gaps where it needs to as well, that you inject stimulus to increase demand to get people to start spending either more or the same amount of money at a higher quantity to get the markets moving again, right? So if the market's coming to a lull and everybody's risk off and they're afraid to spend money, let's just inject some money into the economy, and people will start spending that money, which is an accurate statement, right? You consume at the same rate that you do over your entire lifetime, regardless of what your income is. You put the same amount in savings and the same amount in spending, right? So if you increase the amount of money you have, then there's going to be an increased amount that you spend and save and blah blah blah. So the problem with that is really the entire problem of central banking in the first place, that the Austrians, who don't get nearly as much credit or fame as John Maynard Keynes did, was their primary concern, which is a boom and bust business cycle as a result, where the he refers to the stimulus as, and by he I mean Friedrich Hayek and Ludwig von Mises and those guys, refer to it as like a drug, right? Because what happens is the stimulus that you inject into the economy is what's helping fuel the next thing to cause the next recession. They call it malinvestment, right? So the idea is that when you print too much money, the person going around, remember this beautiful language of the pricing system where buyers and sellers communicate. When you inject money into the market, that language gets diluted, right? Everybody starts speaking in their own individual, really heavy accent that you can't hear. That's the best way to put it, right? It becomes a game of telephone. You're not really understanding the language in the same clarity that you previously did, because the underlying rules of that language have changed, right? You injected the economy with stimulus. And let's say you think you have all of the investment goods necessary to build a house, right? Because you have all the stimulus telling you that you have the investment goods necessary to build a house. So then you go and you get the materials, right? You get the wood, you get the bricks, you get whatever it is else that you make a house with. And you get done to finishing the house and you realize that you made all your investments improperly and you actually can't finish it. You didn't get enough wood for the amount of bricks that you had, right? And you didn't plan any of that out properly. And who could fault you, right? You just were given money and told to spend it and go and told to invest it. and you didn't realize that you were investing it in the wrong places until you get to the end of making the house and you realize that you don't have the materials to complete it. This is what stimulus and inflation does to an economy if you do it in an excessive rate, right? Malinvestment. And what happens then is when you get to the end, all of that time and investment that you spent went to waste, and that fuels a worse, more dramatic recession. Well, and then you got to come back to stimulus again, good old stimulus to help get out of your recession problem. So yes, short-term solution, it works. The economics are there, right? People do start spending more when they're given stimulus. The problem is that you compound this over and over and over again. It actually theoretically increases the severity of the boom and the bust cycle, which you're not looking for, right? I will gladly take, steady growth that kind of looks like this as far as economic growth goes, than economic growth that looks like that, right? And people would argue on this, but that's what economics is all about. Is there's debates, and Keynes had a lot of good ideas that caused a lot of good conversation and dialogue, but it's a lot of his ideas didn't totally stick. What's the other thing? Do you think a society running on crypto would be inflation proof? Absolutely not. Bitcoin might be inflation proof, and I think there's benefit to things being, inflation proof or deflationary or anti-inflationary or whatever you want to call it. But like, a normal rate of inflation is healthy, 100%. And like, you need a normal rate of inflation for things like trade and credit and debt to kind of work properly, and interest rates to work properly, right? But when you want a normal rate of inflation, you want the Federal Reserve's target of an average of 2%, which previously was just under 2%. Then they changed it to an average of 2%. And now they're saying, yeah, we give up, because they're dealing with 8.5% year over year inflation, which last I checked is over 4 times higher than their average target, right? Look, you're not going to hear a ton of complaining from me if our inflation rate increases at less than 2% a year. If we're dealing with 1% inflation a year, that's totally fine. That's totally healthy, right? It's when we do this with our money supply and act like absolutely nothing harmful is going to come out of it, and then the result is, well, a ton of harm, right? That's a huge body of text. So sorry, I'm going to remove that real quick. But that's essentially, what the result is. And like, we still had inflation. We still had inflation when we had the gold standard, right? But at least we had like a base that was keeping that inflation and that monetary base increase in check. We don't do that anymore. And it allows the Federal Reserve to get away with situations like this, which translates to the highest inflation that we've ever seen. Sorry, this is housing prices. I like how it's just clicking over that, being like, see, inflation. When that is just an asset price increasing. Here. Oh, sticky price, consumer price index. That's interesting. But yeah, inflation. There we go. This is the graph that I apparently was looking for and having such a hard time finding. All right, that's the result of too much of the monetary base. Keynes got a lot of things right. Don't get me wrong. There's a lot of things I disagree with. There's a lot of things I think are wrong, but he did also get things right. Never seen this. Yeah, Steven tunes in all the time, and it's basically that Always Sunny in Philadelphia meme where the dude's just like showing the whiteboard and like screaming. That's like me with this monetary, this M2 growth graph over and over again. Is M2 increase a problem if it correlates with an M2 velocity increase? Velocity has been on the floor since 2020. Are there any Fed levers to increase that besides the stock increases that we're seeing? Great question, Joe. And really quick, it's worth. When we say M2 and M1, it's just the way that we're categorizing the monetary base. The M1 money supply is the currency in circulation, deposits, travelers' checks, things like that. The M2 money supply takes all the more liquid money and then also includes savings, money market funds, things like that, right? So M1 money supply is liquid money. M2 money supply is just a more broad sense of here's the entire monetary base. If we take a look at money velocity here, as Joe said, it's on the floor, right? It's just been on a constant decline. And by the way, money velocity is the amount of transactions occurring in an economy with the monetary base as the denominator, right? You can pull up. Right. So it's your prices with your number of transactions. So the amount of value being transacted, right? The literal value of it times the quantity of the transactions occurring divided by that monetary base, right? And the idea is that the more you increase the monetary base, the smaller that your PT number gets, right? The number of the value of the transactions and the prices occurring at the same time. See, I'm literally the dude from It's Always Sunny, just screaming at the whiteboard. Um, so, there's a pretty big debate on the importance of money velocity. I personally think it's very important. Milton Friedman thought it was very important. And the idea as a monetarist is you're trying to maximize it by keeping this monetary base as small as possible, but maximizing economic activity. So to get to your question finally, Joe, does the Fed have any levers to increase that besides the stock increases we're seeing? The main thing that they have to increase money velocity is actually to lower the money stock, right? So what you're looking for is high levels of economic activity, economic growth, economic health with low levels of inflation and monetary base increasing, right? Which is totally possible. That's you have a healthy economy with interest rates people can expect, money liquid enough for people to make transactions, et cetera, and you just allow growth and deflation to do its part and maximize this money velocity situation. But instead, we keep growing our monetary base to stimulate this transaction thing. And then as soon as those transactions start to decline, we start growing our monetary base again to try to force it back up. Right. And your result is right. You can literally see this based on the recessions, right? I wish I could. I might be doing something uncouth here, but let's see. This might give me what I want. No, not really. What you do see, which is kind of what I was hoping for, is the interest rate changes and how money velocity plummets, and then the economy starts kicking again and increases. But this is not what we're looking for. I would not use that as actual useful data. So excuse that, ignore it. But what I'm trying to show here is that right, you had growth, and then you had the 2008 recession, the bubble pop, right? Which as soon as that happened and we went into a recession, the Fed started injecting more money into the monetary base, and then you see this decrease in velocity, right? So you see this short-term upkick while we're not printing money like crazy and we're raising interest rates and things like that, and then you see this downturn when we do exactly the opposite of that. So yeah, I mean, keeping the denominator consistent is how you try to increase money velocity, and we have been failing to do that. El Salvador, which adopted Bitcoin, has a lower inflation rate than us, but admittedly, I do not know the degree of causality. El Salvador has about half the inflation rate that we do. They're chugging, I think last I checked, at 4.2% year over year inflation, while obviously the United States is over 8%. I do not want to credit Bitcoin with that, though. I would actually credit, believe it or not, the value and power of the United States dollar and how we feel those inflationary shocks worse because we're using the global reserve as our standard monetary base, and El Salvador, as a country that is not as economically privileged and developed as us, is taking advantage of that world reserve dollar. Again, El Salvador, their currency is the United States dollar. They don't have a different currency. So then adopting Bitcoin as legal tender, right? I mean, one thing I love about it and I'm a huge fan of El Salvador doing this, and I think it will pay massive dividends in the future for them. Do not get me wrong. But it's important to note that right, they're getting the benefit out of this because of the fact that Bitcoin's now kind of serving as like this gold-ish standard, in the sense that they have a certain amount of their holdings of their M2 in something that we know for a fact is deflationary, right? There will only ever be a supply of 21 million Bitcoin. You can't inflate that supply further than 21 million. But I don't want to credit that for reeling in their inflation rate. I think the main thing is that they're a country using the world reserve currency that is the United States dollar, and their economy is growing and developing, and they're seeking investment and a lot of really positive things there. And yeah, they're a very attractive destination for both vacationing and investment, and that has only increased as of late. So, there's probably even more logistics to that. I wish I knew more about the mechanics of El Salvador's economy, but I think, again, their use of the United States dollar probably has more to do with it than Bitcoin. As much as I'm a Bitcoin bull, and I absolutely love taking a Bitcoin victory lap whenever I possibly can, I unfortunately cannot, as an economist, credit El Salvador's lower inflation rate to Bitcoin. But that brings up a really interesting conversation. So everybody knows that the stock market's been getting crushed. The crypto market's been getting crushed. It's a very much risk-off environment. If you want proof of that, we can take a look at the weekly chart or the daily chart of the Dow and know that since our top in the 4th of January, we have actually been in a sustained downtrend with lower highs and lower lows, right? When we went over this "Are we in a bear market" video, we said, well, uptrends can be defined by macro higher highs and higher lows. And for the first time in a long time, our major indexes, the Dow Jones, the NASDAQ, and the S&P 500, are seeing lower lows, right? And I expect this downtrend to continue for a while, maybe 3 months, maybe 6 months, maybe longer. I'm not sure. All I know is that we have been on a pretty crazy bull run for the past decade, and it, couldn't hurt to cool off a little bit. It won't cool off as much as all the bears are saying it will. Again, they think this is like a dot-com bubble top, and we're about to see like an 80% drawdown in stocks, and that's just not happening. I'm sorry. I'm bearish right now as far as the markets go, but I am not dot-com bubble bearish or anything close. But one thing that's really consistent when stocks are hurting and crypto is hurting is that the United States dollar is rallying. Wait, John, we've been talking about currency debasement and inflation for the past 43 minutes, and now you're trying to tell me that the dollar's actually been appreciating in value? Yes, the reason why is because the US dollar currency index is measuring it against other fiat currencies that are also inflating, right? If this was measuring against something with a stable base, it probably would not look the same, right? If you measure the United States dollar against Bitcoin, Bitcoin's been winning that race ever since Bitcoin's existed, basically, if you zoom out and look at the long-term trend. But I just kind of, a long time ago, I like individually drew lines to kind of like, see where this uptrend's at. And then I got lazy and just kind of did this pitchfork. So the support and resistance levels here aren't perfect, but they do just kind of serve as like this channel that the dollar's been in since about May of 2021. Interesting how Bitcoin hit its like significant macro top there. And then I have blue resistance lines drawn at each like major top the dollar has seen, right? And let's just zoom out big picture here, because I think zooming out, looking at the dollar's big picture is really important. I don't know why that particular blue line looks like that. That should look like this to signify the downtrend that's going on. Sorry, not me just fixing my charts. Right, so long story short, since the 1980s, the this currency index has shown that the dollar's been in a downtrend against other fiat currencies, and it's just, I mean, it's been losing value in the first place, right? The lowest that it's been against the other basket of currencies was during our 2008 recession, so I could maybe do a horizontal ray there to kind of signify bottom. And then when you zoom in, right, we're lower than we were back in the early 2000s, right, which is, this is dot-com bubble deflating, and then this is kind of like the stock market starting to gain some confidence and rally again. And we have yet to put in a higher high from that level, and I don't think we'll ever get to this level again. But hey, you know what? Let's give it a nice little benchmark goal line, right? So you have this high here, and then the dollar's main point of resistance has been kind of this area right here at 103.8. And it tried to get up there right before the pandemic truly started, and then it went into a long downtrend. And then in May of 2021, it's been in an uptrend where I have this pitchfork thing. I'm gonna make this blue because I'm noticing how ugly and unaesthetic just this like giant white ray going across my screen was. Aesthetics during my technical analysis are very important to me. Let me have this. And then you can see that the dollar since then has just been doing nothing but flipping prior resistance into support, right? Struggled for a bit at this top, broke through it, retested as support, broke through the next one, retested that as support, right? Broke through this one. I thought the dollar was dead here. I thought, oh, yeah, we're entering your downtrend. I was wrong. Broke through it, retested as support, broke through it. We're just breaking resistance over and over and over again. So now the question in everybody's mind is, you know, these prior tops from up here, right, with this being the tippiest top, are we gonna get rejected at these finally, right? Or are we just gonna break this and flip it into support, and break this and flip it into support, and just keep heading up? That would be bad for Bitcoin. That would be bad for the stock market, right? Consistent dollar index bull run means that equities and crypto are suffering hard. And I mean, what have we seen, right? Since March of 2021, right, or May of 2021 rather, the stock market and crypto has been struggling to put in new highs, and especially as of late. And as long as we see this relentless uptrend from the dollar, that will continue. But who knows? Optimistically, you know, maybe we break past this one, but we can't beat the final boss, and we hang out here, and then we start falling down, right? Totally possible, and that's when you'll see another bull run kicking in the stock market. So yeah, just, I don't want to give timelines here, but like we're gonna be coming up on this level pretty soon. We're gonna be coming up on that level if we break this, probably a few months after that. Optimally, I'm hoping like Q3, Q4, we're looking bullish again. I have no optimism for the summer looking bullish, but for the fall, assuming, you know, World War III doesn't happen and inflation starts to cool down, I can suggest that stocks and equities are looking a little more bullish. Also, again, for newcomers, for people just popping in, thanks for checking out my econ analysis stream. I really appreciate it. Additionally, if you have any questions whatsoever, feel free to ask in the comments. This is a ton more fun when I'm answering your questions, and I appreciate the time of day that you're giving me here at 8:49 on a Wednesday night. Also, do we want to do some stock analysis, right? Because I've done nothing but talk about inflation and housing prices and the dollar index and stuff. But if you guys have any stock requests that you'd like me to do some analysis on, I'm happy to. But the one that I'm going to do right now is our trusty friend Bitcoin, because I like the crypto market. Surprise. So one thing that's interesting here, first of all, this whipsaw has been brutal if you're a trader. Just saying. I've been pretty confident in my trading abilities since the past year of doing so, right? It was a rocky start, as I'm sure it is for everybody, and I got the hang of it and was trading very well for probably a good 6 to 8 month stretch. And I even felt really good about some bottoms that I locked in this area. And this whole section, I've just been getting chopped to bits. And I just decided, you know what? Market's on hard mode. I will come back to trading when the market is on easy mode. And also worth noting, having good invalidation for your trades, having clear, consistent invalidation for your trades is how you avoid losing a ton of money on your bad trades, right? Worked really hard to make profits on my good trades. I'd prefer not to flush it all away because I'm too stubborn to invalidate my bad trades, right? You got to take the loss, because taking a little loss can save you from taking a ton of loss and losing money that you worked very hard to earn. So I just want to talk about diagonal support and resistance here, because people are drawing this pattern a lot. And don't be wrong, there are definitely reasons to be bearish on Bitcoin. It can definitely break down. I actually think a breakdown and capitulation in the short term is more likely than a bull run. But what a lot of people are drawing is an ascending wedge. And ascending wedges are these like tricky patterns that you can draw to make this chart be like, oh, this is a bearish chart, right? Like everybody, goes to this conjecture of, right, descending wedge. Oh, we're looking bullish, right? And ascending wedge. Oh, we're looking bearish. And don't be wrong, when I first was trading and doing stock analysis, I fell for these little gimmicks as well. But you can literally do this with like anything. Because here's the thing is you can always move diagonal support and resistance once you lose it. You just change the line. And that's why it's silly to use it, right? I could have made an ascending wedge out of this, right? Like, oh, ascending wedge, we're due for a breakdown. And oh, we got my breakdown. If you draw a triangle to the upside, anytime it moves down, it's eventually going to lose that diagonal support, especially if you only have a couple touches on it, right? It just looks silly. And people were drawing patterns like this all the time, trying to say, oh, I'm a genius. The S&P 500 is due for a bear market because I drew this ascending wedge. But here's the thing. I can literally just move the line. Well, there's my new ascending wedge, right? And until further notice, it's just going to be an ascending wedge until it breaks down to the downside. And then, oh, I was right. I drew a proper ascending wedge, which is why diagonal support and resistance is silly. You want to use horizontal support and resistance because it's like a clear definition if you lose it or not, right? It's less arbitrary. It's less subjective. So for trading and for analysis, it's better to do that. Because I'll tell you this much. This descending wedge did not feel like a bullish pattern at all when we were experiencing it. In fact, I remember this clear as day, right? We had this support, a horizontal support, mind you, drawn out like here. And when we started getting daily closes below that support line for the first time, all hell felt like it was going to break loose. It felt like it was the end of the world. We are losing a super critical support line. And then, all some dude had to do was take his descending wedge that was, breaking down when it was drawn out like this and just move it a little bit. And oh, okay, yeah, it's a perfect descending wedge. And now we're headed to the upside, right? Really good post hoc justification there. And that's not what we're looking for when we're trying to trade. Right. Same thing. I mean, you could draw, right, like an ascending wedge on this. And then, oh, we broke down, but really it was a fake out when we put in new highs, right? So it's not like it serves its purpose, I guess. If you want to try trading with ascending and descending wedges, go for it. It's just not my cup of tea. Horizontal resistance and support is a much better way to kind of get your road marks placed. And sure enough, right, we can break out of here and then this looks silly again, or we can, right, fail and then come down. and everybody will say that ascending wedge worked, but I just don't think it's a good indicator. So quick lesson in technical analysis there. Ross said, Sam, I own a good chunk. These pop up urgent cares everywhere. I like the story. Please tell me your technical viewpoint. Ross, good to see you. Thank you for watching, and I am happy to check this out. Okay, so first thing that I'm seeing here is this looks a lot like just how the general stock market is trading. So I'm going to go to the weekly moving average. The very first thing that we can identify is, are we still in a bull run or not? Best way to take a look at that is by taking a look at the 20-week simple moving average, which out of all of these lines is the gray line, right? I have the 20 and 21-week exponential moving average that move together kind of as a band. And then I have the 50-week moving average, the 100-week moving average, and the 200-week moving average. So looks like over this asset's history, it does not spend a ton of time under its 200-week moving average. So that's good to know because it looks like it just caught its 200-week moving average as support. So if you are dollar cost averaging into this particular asset, this wouldn't be a horrible time based off of technicals, not financial advice, to dollar cost average a little bit heavier into the asset, because historically, when it flirts with this line, it doesn't spend a ton of time beneath it. This is some craziness. I'm assuming this is the March 2020 capitulation. So everything was craziness. A bunch of technicals broke there. Yeah, I mean, it looks like this, besides the March 2020 capitulation, the only other time that I'm seeing sustained amount of time under its 200-week moving average was in January to February of 2016. It was underneath its 200-week moving average for about a month, right? And eventually reclaimed it, accumulated, and then it looks like went on another good run here. So bright side, you're probably bottoming. You might, continue to see some downside, but I wouldn't think it's sustained. One thing that is obvious, though, is we're no longer holding the 20-week moving average as support. We lost it there, and look, and then you had a failed underside retest, right? And this is what I look long-term technical analysis. Are we bearish? Are we bullish? This is the exact opposite of what you want to see, right? What you want to see is an asset getting above its 20-week moving average and then consistently testing it as support, which it did. It got above it. It tested its support there, tested its support here. I'll give it a gimme, and here. And then when it broke beneath it finally, which it put up a fight, right? It had 2 weeks of trying to hold it as support and it failed. And then what happened was it retested it from the backside as resistance and confirmed it as resistance. And then from that point on, right, let's say the minute that this actually failed and you were unable to get above your 20-week moving average, you saw a top to bottom 39% drawdown. And man, like, and this is not my original creation. You can't copyright moving averages, but using the 20-week as your bearish to bullish indicator, Ben Cowan is the one that popularized that in crypto technical analysis. And oh my goodness, is it consistent and useful. I cannot give enough credit to Ben Cowan. That dude is a genius. And I think that indicator, out of all of the indicators that he uses, he refers to it as the bull market support band. It is brilliant, brilliant stuff. And this is my noisy Bitcoin chart. Let's go to my less noisy Bitcoin chart. This is exactly what we see with Bitcoin. This wouldn't even get a fair underside retest, but we broke beneath the bull market support band, and top to bottom from when we broke beneath to the bottom that we put in, 39% drawdown, right? We came up, we held it as support, we put in a new all-time high. Whee! Right? Broke beneath it, failed underside retest, 36% drawdown. Tried to get above it, failed to hold it as support is the most recent thing in Bitcoin's story. So we'll see what happens. All right, we failed to hold it as support. There's a decent chance that we're in for another pretty serious drawdown, right? So getting above the 20-week, holding it as support for several weeks and moving up is a phenomenal bullish sign. And if you fail to do that and you have failed underside retests, things can look really ugly really quickly. So yeah, Ross, thanks for pointing that out. And as far as pattern drawing here, which I don't tend to do, especially on assets that I'm not like actively trading, but you can take a look at this, right? So again, diagonal resistances, so silly, right? Because like, where is the downtrend? When did I know the downtrend is broken? Where am I choosing to draw that from? But if you take horizontal resistances, right, you can say, okay, there's resistance there. I'm seeing kind of like a range. And again, all this stuff is subjective, right? And I'll get rid of these ugly moving averages so we just have support. So I don't really see any super obvious support zone out of prior price action, right? Because the price action becomes less relevant the more time elapses here, or it tends to be. That's not always a rule. But yeah, I'll just draw that arbitrarily and say that's the bottom, right? So you kind of have these zones. I would say this looks like a failed underside retest. So realistically, right, you could maybe come back down to like $21 and start heading back up, right? That's to the spot 2142 was where it is short-term bottomed at. So just random volume spikes there. It's interesting. But yeah, I mean, this looks like a failed underside retest on the short time frame too. So I could see that coming back down to 21 and then heading back up. We'll see what happens. We'll save that. And we'll check back and just see what ended up happening later. Any other assets that people are feeling, feel free to toss them in there. Ethereum's been looking like relatively strong compared to Bitcoin. I'm going to take a look at the Ethereum Bitcoin valuation. I've had a very long-term triangle drawn out here, right? And maybe at some point this breaks out and starts outperforming Bitcoin. Here's Ethereum's like long-term picture against Bitcoin, right? Topped out in June of 2017, topped out January 2018, and now you have like this, nice kind of routing bottom-ish shape, and then we've just kind of been accumulating, right? So I don't know. I think what Ethereum does here depends a lot on how quickly Bitcoin gets bullish, because when Bitcoin looks truly bullish and the crypto market looks truly bullish, everything bows to Bitcoin, right? But if Bitcoin looks consistently bearish, Ethereum might be a better hedge against Bitcoin for the short term. What else to look at? Keep the questions coming, guys. I'm probably going to wrap up relatively soon. I think this, for a Wednesday night stream, man, this was a crazy successful stream. Thanks so much for anybody that popped in and hung out and all of that good stuff. But yeah, I really appreciate. I mean, I think we got as high as like 10 viewers at one time at one point. I think this is one of the stronger ones that I've had. So I'm really excited about that, and I very much appreciate it. Gold's continuing to look super strong. Like, I cannot have a more perfect technical chart, in my opinion, than what gold looks like over the long term here. And it's just all because of this cup and handle type pattern that we have going on here, right? And then break out to the upside. I mean, I think, if you actually were to draw a flag from that, right? Like you're looking at long term. I mean, over the next decade, right? Which is not helpful, but that's how long gold kind of takes to do its thing. Like you could have $3,000 gold, right? By like over here, right? I mean, that's what this kind of long term rounding bottom, cup and handle type pattern would suggest, is that eventually we broke out to the upside, and eventually over the next decade, it should just kind of, do something like that. Um, uh, I believe that all of the equity indexes are still in bad shape. Right now, this is looking like a failed underside retest of its bull market support band. So, you could expect some downside here and it catching up at, the 100 week maybe, right? So, which by the way, like these were like the best prices ever, not 6 months ago. So when people calling it a dot-com bubble pop, it drives me nuts because like, oh, the Dow Jones visits the 100-week moving average which is currently at $32,000 and rising, right? Which was a price that we cracked for the first time not a year ago. We were so spoiled. So spoiled. We just know nothing but bull run. And apparently a year-long accumulation phase is too much for people. Sorry, NASDAQ, I have a lot more. NASDAQ's giving me the same vibe, right? Which caught the 100-week, moved up, failed underside retest of the 20-week, and moving back down. I don't want to speak too soon here, but some people would refer to this as a dead cat bounce, right? A false rally so that people can capture some exit liquidity up here, right? Get people just ever so slightly excited about the market to get some people to think that we might be bullish again, and just using it to exit, right? Getting their sales out, exiting all the stuff that they want to. It's the highest price they're going to get for a while. And, maybe we just accumulate in a downtrend for a year or whatever. These time frames are totally arbitrary, just saying. And then S&P 500 was the one that came the closest, but we didn't get there, right? Got above its 20-week, had one weekly close above it, went to hold it as support and failed, right? And now, we'll probably get some kind of underside retest type vibe and then pushing down. With the interest rates going up again, right? That's a 50 basis. So interest rates are going to be back here by May, right? So that's cool. I honestly think like the max pain is over, right? The like the quickest, most painful downtrend of going from, right, 13% drawdown on the Dow, or 22% drawdown in a matter of 2 months for the NASDAQ, right? Like we might get another like a true capitulation event, but like I genuinely think that like we've priced in the interest rate increases, we've priced in the really crummy macroeconomic conditions, we've priced in the inflation. People just saw this nice exit pump opportunity and took their profits. The people that were going to take profits there took their profits, and now we're just going to be, selling for a while, right? But eventually, all right, I again, barring World War III, like I think, which not saying, like that's an impossible thing given the current environment, but barring World War III, I think that like it's not going to be bearish for several years, right? It's not the dot-com bubble again. Yes, life would be better if we just traded guitars. Russ says, with having younger viewers, here's some homework to read before the next stream. Using retirement assets before retirement age to purchase rental income property. There are plenty of rules to follow, but imagine the max out potential with rent coming into your retirement plan, not counting as an annual contribution. I talked about this on the stream too. When you have record inflation, but interest rates don't increase, which they're starting to increase, but for a good year, right? People were able to lock in some really low interest rates pre-high inflation. Like there's no better asset that you can make profit on given that circumstance than realty, right? And the reason why is because let's say you get a $100,000 mortgage And just to make my life as easy as possible, we're going to do at a 1% interest rate, right? So you're paying $1,000, right? For the interest rate compounded given any amount of time, right? We don't have to get super technical and specific because I think you'll understand, right? If you could pay this off quickly, it'd be $101,000, right? But then let's say you had 10% inflation. So the purchasing power of this $100,000 that you took out the mortgage on at a 1% interest rate turns into $90,000, right? Your interest rate remained the same. Your inflation was 10%. The purchasing power decreased, which means the number that you're denoting in everything has to increase for things to feel like somewhat samey, which, thankfully we've seen somewhat of an increase in wages over the past 2 years with all this inflation. But unless you got upwards of a 9% raise, you're actually breaking even. But what you use there then is, okay, I'm literally getting paid to hold debt at this point. Inflation is paying me to hold debt because the rate at which I am paying this debt back at is not a rate higher than the rate at which the dollar is devaluing itself, right? So then when you're doing that, you are literally taking advantage of a loophole that allows you to lock in an interest rate that basically doesn't even matter, right? So that's why all of these asset managers and all of these major mega corporations started buying up property like crazy the past year, despite the housing market running hot, because everybody's trying to lock in debt at a very low cost before the dollar devaluates the ever living heck out of itself, so they can just ride the inflationary wave of that. Now, when you have hyperinflation, interest rates start to creep up really fast. In fact, when you have moderate inflation, interest rates start to eventually creep up. But dude, like if you locked mortgages down here when inflation wasn't doing a whole lot and interest rates were effectively nothing, it's beautiful. Don't forget, what's the one asset liability that isn't taxed? That, yes. In fact, just savings are taxed, right? Where if you held your money in a bank account in the past 2 years, you've lost 12% of that money to the devaluation of the money itself. It's the invisible tax. So saving you can easily get taxed on, just through the invisible tax that is inflation. But yeah, it's and that's the thing. Like, what's how am I forgetting the dude's name? He's the no debt guy, right? Somebody was going to know his name. It's Dave Ramsey. There we go. Right? Like, I'm sorry, your lifestyle shouldn't be drowning you in debt. And this is not financial advice. Your lifestyle should not be drowning you in debt that you can't manage. But a manageable amount of debt is incredibly healthy, right? It works to your benefit more often than it doesn't, especially in an environment where the dollar is getting inflated away and the asset that you have now will likely be more valuable later, right? Houses, that's kind of what you buy houses for, is to assume that over time, the price of it's going to appreciate and you'll be able to sell it at a higher price than what you bought it for. And apparently people are thinking that in a super great hot housing market in general, that's not a bubble, as we discussed earlier. All right, guys, the questions keep coming, and as long as the questions keep coming, I'm going to keep talking. But we can check out some other stuff while I'm waiting around for those questions to come in. Oil has been continuing to increase. That is no surprise to anybody, though everybody knows my thesis with commodities is that new supply will eventually enter the market because people are looking to chase supernormal profits. When people are looking to chase supernormal profits, they get bid away from doing things that have not supernormal profits to start chasing those profits. That extra supply that enters the market eventually normalizes the price. This is very consistent with goods like oil and other commodities that you don't care where you're getting it from. There's no brand name to oil that really matters to you unless you're like upset about, I guess, an oil spill or something like that. But what that means is that commodities prices, they can do crazy things in the short term, but in the long term, they always kind of eventually find like a stable state and range to hang out in that's healthy and normal for an economy. Um, what I'm looking for here is if oil does put in a higher high, right? So we have a high, low, a higher low. Will we put in a higher high again? What I would be looking for is a bearish divergence on the RSI. The momentum on that high is not the same as the momentum of the previous high, and you might be seeing a reversal. That trend that I was talking about with commodities, right? That's over the long run, not the short term. So very important to remember. Um, see. All right, I'm not seeing any other questions come in, and I think my viewership has dropped in like half over the past 5 minutes. So I'm going to leave it at that, guys. Thank you so much for hanging out. Ton of questions this Wednesday night. It's what makes this incredibly enjoyable. A lot of really good questions. Greg always has great questions. Joe, when he pops in, always has great questions. Ross, it was awesome to see you asking questions. Makes this whole thing a lot of fun. I hope everybody has a great night. Stay safe out there. Enjoy your holiday weekend coming up, and I will see you next week. Actually, I will be posting a song on Friday with my buddy Connor. So see you guys on Friday with a new song, and then back to our regularly scheduled economics programming the following week. Have a great night, guys. Bye.